Good afternoon, everyone. Welcome to today's market stream. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market ETFs. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. And of course, we'll do that through their ETFs, the SPY, the QQQ, IWM, and DIA. Once we finish looking at them, we will also take a quick look at the US dollar. We'll look at gold, silver, and oil, see how they're behaving, see if commodities are affecting the markets in general, and then from there we'll move on to any chart requests. If anyone has a chart request, feel free to type it into the chat now, and we'll get a chance to take a look at them during the second half of today's session. If you like what you see here, you can always follow me at Twitter under the name StockDarts, YouTube under the same name, or you could visit us at patreon.com/StockDarts, where I post weekly blog content including trade ideas, watch list ideas, as well as reposts of these Wednesday market reviews. Also, if you have any questions regarding any of this stuff, you can always type it in the chat, or you can ask me on Twitter as well. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 through the ETF SPY. Alright, so it's an interesting week so far. We're seeing positive price action out of the S&P 500 and the NASDAQ to a certain extent. And we're seeing a little bit of regression on the Dow and on IWM, which of course are the small caps. This is a little bit of a different story compared to what we've seen last week and what we've actually been seeing throughout the middle of November, or even most of November, and as we keep moving closer to the end of the year. There's been a bit of a rotation. A lot of that happened right around the beginning of November when Pfizer announced some of the details of their most recent vaccine study, and on the hopes of a vaccine coming in, and I think we're starting to get them shipped out even now as we speak. And that sort of started a rotation into some of the more beaten down sectors that have really struggled with the pandemic and with the way we've been having to kind of work and consume from home. And so that rotation, of course, has been into, you know, the away from the work at home and shop at home stocks, and into some of the more some of the stocks that are more involved with travel and you know, just people just generally leaving their homes, stuff like airlines, cruise lines, restaurants, retail, you know, that sort of stuff. And what we're seeing this week is a little bit of a reversion of that, and going back towards some of the tech names and some of the safer names that have been doing well all year, and sort of away from the small caps in particular. Although it's more of a chop than anything else. I don't think this is indicative of a bigger trend that we're seeing yet. I think this is just a matter of money kind of rotating as people take profits, and you know, just kind of stalling out a bit. And as we go through the four major ETFs, we'll get a better picture of what I'm talking about. You'll see it a little bit more clearly with pictures, and we'll go from there. So first up, like I said, is the S&P 500 and SPY. And as you can see, this is actually a pretty nice breakout. Now, we alluded to this last week, and particularly on my Patreon page, when I was mentioning with IWM breaking out. And if you go back to IWM for a second, you can see IWM broke out a couple of weeks ago. And they were kind of leading the way upwards. And so we finally got SPY to follow suit and break out of their range. Now, this is kind of a critical breakout. Hold on a second. Alright, so we've got a decent breakout here. Now this is kind of important because we are actually above the highs from that day of the vaccine announcement, right? So this was kind of an important candle, this big red candle from November 9th. We gapped higher over the weekend on significant news, of course, with the vaccine, and we faded the entire day. And this candle has basically set up the range that we've been stuck in, and it's almost like a demarcation of what the highs and the lows of the pretty much all of November have been. You can see we formed a nice triangle with the highs of that day counting as the ceiling, and the lows being pretty much where the floor is. Now, we did have a couple of days just below that, but as you can see, we closed both days right around the lows from that November 9 candle, and we've been slowly making our way back up to try to test the top. And this happens a lot. This is kind of important for those of you that are maybe still trying to figure out how to use technical analysis, understanding, trying to understand which candles are important or why you want to look at certain things. These kind of important candles, look at the volume spike on that, right? We had a high volume for pretty much almost the entire second half of the year, um, right? And it was a kind of a significant candle that really became important in outlining different areas of the market. That became the floor and the ceiling for the next month of price action. Now, we're finally breaking above that, right? And so it's important when you look at these candles, there's certain candles that become really emotional and become very critical anchor points for the price action that's going to follow after that. Another critical candle was this one on September 3rd, which was a Thursday, in which we kind of really started to break down after the market was really stretched out. And that candle and the candle after that, that became a really important anchor point for the market. You can see it was a ceiling that lasted for a while and then was basically the floor as we tried to break out. Once we failed, we kind of headed right back south, and it was once we started to accelerate past that that we kind of changed the market dynamic and entered into what we're doing right now, which is again kind of consolidating right below highs and then trying to push out, which is what we're doing right now. Is we're trying to break out past that level. So it's important for you to take stock of these and understand which candles are more important. There are some that are going to be more important than others. They usually are inflection points and turning points in a certain market. And this particular candle was an important one. And as you can see, we are now starting to move beyond that. And so that's a good positive. And for those either worried about the market or worried that we're maybe at highs and stretched out, I saw on Twitter the other day someone complaining about the market being stretched out or being too high, and I kind of disagree with that. I think if anything, we're doing a really good job of slowly making our way to new highs. If you go ahead, and this is one of the tools we like to use on these Wednesday streams, we just pull out a rectangle and we show what the market has done over the last 4 months or so, or 5 months. We've just been trading sideways. Matter of fact, we had a double top kind of forming here, which ended up not materializing because, of course, we broke out to the upside. But as you can see, if you go ahead and just take a look at the bigger picture and kind of ignore the candles for a minute and just look at the overall price action, what you'll see is a market that was ramping up. It got a little ahead of itself, and then it had to kind of correct, and it corrected through price, but also through time. And it took a few months of going back and forth and consolidating, and just trying to get to a consensus where the buyers and the sellers agree on what good value is and what poor value is, right? And so what we ended up figuring out was that this area around the 320s is good value, and this is an area that is worth buying. And what we did now is we've kind of decided that the area that was previously overpriced, which was this 350 area, right? We've got a top out at 357, then we topped out around 355, and then we struggled again around 356, 357. Well, we're starting to get a little bit of a change in attitude here, where now we have people buying at that level and saying, you know what, this is no longer resistance, this is now support. And so we have this transition where we're starting to get buyers to go ahead and be more confident and expect the market to rally forward. And of course, we're heading into the holiday season, which is typically a good time to expect the market to rally. This is usually a point in the year where we have less volume typically and less significant price action. And when that happens, you tend to get a drift upwards, as there's nothing really holding it back from kind of going up a bit. And so that's what we're kind of hoping for, is that we have a nice Christmas rally heading into the close of the year, and we end off closing 2020 in a really good spot when you consider what has gone on all year, right? So if we go back and we take a look at just the entirety of 2020, right? So we come back here and we start off the year ramping up pretty strongly, and then of course once we got we got wind of exactly how rough the coronavirus was going to be, the market tanked, and it tanked pretty bad. But since that point, at the end of March, we've rallied very strongly, and we've made our way right back through, and have been able to kind of just shrug it off, and are right back to highs, and kind of continuing exactly how we started the year. Now, is this going to go through into the start of next year, and are we going to continue rallying into 2021? I don't know. That's a little bit beyond what we should be expecting right now. As swing traders, which is what this Wednesday market stream is usually focused on, 1, 2, 3 week swing trades. What we're concerned with right now is what we're going to see through the rest of December. And at the moment, it looks good. Again, if you take a look at the bigger picture and you see what we've done, once we reached this level around 340, we started chopping back and forth, right, with a high around 358 and a low around 320 or so. And we've kind of started to leave that area behind and continued upwards. And if you think about it, that's really just an extension of not only this trend, but if we go to a weekly chart, the even longer multi-year trend that we've had in place, right? So this is something that the market has been doing for a long time now, and it continues to build off of that and continues to go upwards. And so what I would say to anyone that's worried about the market right now is don't worry about it right now. Just of course you don't want to be irresponsible and ignore stops and trade with poor discipline, but you don't want to psych yourself out either, and not be involved in a market that's giving us good returns at the moment. And so what we want to do is the same as always. We want to make sure that we're getting good risk return or good risk reward and good returns on our trades, and that we're not chasing price action upwards. And I think that's really the key when you have a market that's strong, is just making sure that you don't let the fear of missing out kind of take hold, and you end up chasing price action upwards. So with that out of the way, let's go ahead and take a look at some of the key levels that we want to watch on the S&P 500 and how we're going to go ahead and navigate and take advantage of trading as it moves forward. So clearly, this area around 364, which of course is the top of this triangle, is short-term support. We're so close to it that there's of course a decent chance that it fails. However, what's critical right now is the bottom of the triangle and this 20-period moving average. Last week and the week before that, we were discussing how the moving averages can give you a good idea on how the trend is developing. When you have the 20 and the 50 start to fan out like this, you get the 20s kind of climbing upwards and the 50 also climbing upwards, but you see the space between them increase. That's indicative of a trend that's beginning to really accelerate. And when that happens, that often leads to a pretty strong move forward and a pretty decent trend. And that's what we've been seeing over the last few weeks is the beginnings of a trend as far as what the moving averages are indicating. Now, of course, moving averages are lagging, right? So when they start to spread out like this, usually it's because there's already been a move upwards that's causing them and pulling them upwards. But as you can see, the markets have given us plenty of time to recognize this developing trend without the risk and reward really getting out of hand. Because really what's happened is we had the big move up, and then we consolidated for 3 weeks before we started to make our way upwards. So at the moment, traders that want to participate in this trend, they actually have a decent point of entry, because at the moment we actually have a good spot where we have support. We have support just underneath price action, and of course we're right above all-time highs, so you can't even really pinpoint any kind of resistance above us. So this is not a bad place to start looking at trades that are starting to emerge from consolidation ranges and make their way upwards, mimicking what we're seeing on the S&P 500. Now, the one caveat to this is that we're not seeing this across the board yet, but I think we will see in the near future, and so we want to just keep an eye on it. Now, we're going to look at, like I said, we're going to look at all 4 of the indices, and then we'll come to a conclusion. But as far as the S&P 500 is concerned, this price action is indicative of a trend that's beginning to emerge and is likely to continue. So I would expect follow through on this and a move to new highs. Now, the warning signs, let's say this ends up being a false breakout, and we should worry about the market. It would be if we lose this triangle, and more importantly, if we lose the 20 and head right back down to the 50. Now, if we test the 50 and bounce, it's still all right, but I think that would put a real dent in our plans for a Christmas rally, or at least a strong Christmas rally, and would likely mean more than anything that the market needs to consolidate a bit further. However, even if we lost the 20 and came back to the 50, I think as far as the overall health of the market, particularly in the intermediate to long term is concerned, it's still fine. Like I said before, we were talking about these different anchor points with these candles that are really important from an emotional perspective, and we have this first candle from November. Well, the other candle that's really significant is the September 3rd and September 4th, these 2 candles, and that has kind of given us a good floor. And so even if we lose the price action from this triangle and we head back down to the 50, as long as we hold above this 342 or right around there, I think that's still indicative of a market that's still making its way upwards and kind of leaving behind the previous lows and establishing new lows. So there's even if we come down here, as long as we establish a pivot point around 342 and make our way back up, that's still healthy. However, that also probably means that the market is not really ready to rally strongly to close out the year. So that's kind of, that'll be more important. I think, more than anything, will tell us that we're still chopping and stair-stepping up instead of rallying strongly. So that would be the one real warning signal for us, is if we lose the 20 and head back to the 50. Now, if we lose 343, which I don't expect, probably not for the rest of the year, but if we do lose that, then that's a warning sign. And that would mean that the market, again, I think long-term is still healthy, but in the short and intermediate term would mean it's definitely range bound and would need to come back and at the very least test this area around 320 or 330 and likely have to come all the way down to the low 320s and the 200-day moving average. So those are your warning signs if you're worried about the market, right? You don't want to worry about it right now. Despite the fact that we have two little dojis at highs, there's not enough here to indicate that there's selling pressure that's going to impact the market. And so we want to be aggressive right now. We want to make sure that we're taking our shots to the long side. If we lose this triangle and lose the 20 period, well, then maybe we calm down a little bit and wait for better price action. But really, as long as it's above the 50, it's still decent and, still something that we want to look at as looking upwards. If we lose the 50 and we lose this green line, then that's when we start to really want to step back and reassess where the market is and what we want to do moving forward. But I think overall, particularly when you look at the S&P 500, this is bullish, and I expect this to. I expect follow through to the upside, and I would say there's a much better chance that we get follow through to the upside rather than some of these negative scenarios we just covered. Now, if we look at the Nasdaq, it's interesting because the Qs have, of course, led the way all year. If there's one area of this market that has benefited from us staying at home, working at home, shopping at home, it's the Nasdaq, right? Whether it's through Amazon, whether it's through Zoom, Netflix, whatever it is, most of our consumption this year, most of our work has taken place through our computers at home. And so a lot of the tech names that are components of the Qs have done really well. Now, it started to lag a bit. And I think you can see that kind of clearly here in that if you look at our all-time highs that we printed back on September 3rd, right before we had the big candle, September 2nd, before we had the big candle on September 3rd, which again is one of those anchor points, and you can see again exactly how it's affected price action since then. But if you go back and take a look at that, we actually have just recently cleared it, and we were kind of lagging behind throughout November as we had that shift in character where the market was expecting us to get back out on the streets and was expecting a reversion back to some of the other maybe more industrial names that have really struggled this year, and expecting some of these tech names to kind of take a hit as they've benefited so much from it. Now, me personally, I think this is still the best area to be involved in because, again, in my mind, this shift to working from home and shopping from home, it's not something that the coronavirus created. It's a pattern of behavior that maybe was accelerated this year. But it's been developing for a while now, and I think it's going to continue developing. And so, even if Amazon, Peloton, Zoom, Netflix, even if they take short-term hits with rotation back into other names, I think long-term those are still very strong names that will continue to do well, regardless of whether we're in the middle of a pandemic or not. Because that was a shift that was already taking place. And there's a lot of names like Adobe, DocuSign, Teladoc. There's a lot of stocks that you can look at that benefit from this pattern. And while they may have struggled over the last month, I think long-term there's still great plays, and I think those are still the types of plays we should be looking at buying dips if we continue to get these rotation games going in. However, as you can see over the last 2 or 3 days, we are starting to see the tech names pick up, and we're starting to see the Nasdaq come up and print new all-time highs. The same thing, the moving averages. You can see the 20 and the 50. They're starting to spread out. They're starting to climb up, indicating a possible trend emerging and a chance for a strong rally, very similar to what we saw earlier this year and what we saw even a couple years ago. We've traded sideways for a good 3-4 months now, and we're beginning to emerge from that range. So again, we take out our handy-dandy rectangle, and we just demarcate exactly what the price action has been since August, basically, and you can see we're starting to peak out above it. Is this a full-fledged breakout? Not yet, but it's starting to look like it. And particularly if we see the small caps start to reemerge and lead upwards, there's a decent chance that we will follow suit with the Nasdaq and the S&P 500. Keep in mind, some of the bigger components of the Nasdaq are Amazon and Apple. They tend to do well into the holidays. Actually, hold on, let's delete that. All right. When we take a look at Apple, and you can see it's starting to kind of break out of its doldrums. It's been stuck sideways. A lot of the FANG stocks have actually been, struggling a bit as we headed into November and even October. When you compare where we are here compared to all-time highs, see what the markets are doing, they've been a little sluggish, right? You can see Amazon still kind of even struggling a bit today. However, they're starting to show the possibility of a breakout coming soon. And if they can emerge and start to push upwards, that will lead to a big rally in the Qs. And like I said, particularly as we head into the holidays. Those of you that are that are members of our Patreon blog, you'll know Netflix is one of the names we were looking at this week, and you can see we had a nice breakout yesterday. It's kind of stuck in neutral today, but we've already kind of made up to one of our first areas. And we're looking for, at the very least, a gap fill and then see what happens afterwards. But you can see Netflix, again, one of the FANG stocks that is starting to pick up a little bit of steam as we move forward, and maybe starting to emerge from this little slumber that it's had throughout November as money has rotated into IWM, into some of the small caps. And so if we see that pattern continue, we should see the NASDAQ break out fully outside of this range and start to rally as well as the S&P 500. And again, that's what it looks like. Now, it may not happen, of course. No one can really predict what's going on. But I think it's more likely that we break out compared to reverting back lower. Now, what happens if we do revert lower? What are the levels that we could look at? And very similar to the S&P 500, first thing we want to look at is our triangle. Right? I don't think the top of the triangle is significant because we're so close to it. It's important that we kind of hold above it, but if we drop back below it, as long as we don't really break the lower end of this triangle and we don't break below the 20, we could use this as support and expect a bounce. And this often happens when you break out of a range, particularly one of these big rectangles, is you break out, you come back and you have to retest that and just make sure that there's enough buyers to push upwards, and then you really start the rally. And so as long as we hold above the 20 and we hold above this ascending trend line, I think we're fine. Now, if we lose this ascending trend line, we're going to head back to the 50. And like I said, that's probably going to put a big dent on our hopes for a strong Christmas rally. But I think in the intermediate term, it doesn't really mean much because we're still above a pretty critical zone, which is this 283, which I think is more important. And again, you can see price action changed once we crossed this green line, and it started behaving a little bit differently from what it was doing before. And as long as we hold above that, I think we're okay. Because again, we had a break above it that failed, a break that failed, and then this last time we were able to break above it and hold. And so we don't really want to go backwards and fail here. So as long as we hold above that, we should see higher price action. Again, everything here is indicating that the market is ready to move forward. And so that's the way I'm going to go ahead and approach it. Now again, does that mean I'm just going to blindly buy stuff and just kind of hold? No. I want to make sure that whatever I trade is going to have good risk reward, is going to be emerging from a consolidation range rather than chasing highs, and make sure that I have the best chance of succeeding on a trade rather than trying to get the market to fool me into something that's either ready to pull back or not really ready to break out. So you want to make sure that you're still disciplined, but you want to make sure you're focusing to the long side and you're not too timid in this type of environment. Now, in contrast to the S&P and the NASDAQ, you can see the Dow Jones starting to get a little sluggish. Still stuck in the triangle. It hasn't broken out. It tried to break out yesterday and failed, and is right back inside this triangle. So, the Dow and IWM were starting to show a little bit of strength, particularly as we got the vaccine hopes. And so this was the rotation we were discussing, how money was rotating. And again, the Dow has some components like Boeing, Caterpillar, some of these names that really need us to go out and start working again and traveling again. And they started to do a little bit better. But as you can see, with money rotating back into the SPY and into the Qs, it's starting to rotate a little bit out of the Dow and IWM. Now, I think at this point, not enough to be worried about. Um, I think we're still fine, and this is just indicative of a market that's still chopping as it gets ready for a move. And so I'm not really worried yet as far as the money rotating back out of the Dow or out of IWM, which again you can see IWM is the only red index today so far. The other three are basically flat, and IWM is red. So again, the Dow and IWM are underperforming slightly compared to what we're seeing out of the others, but generally speaking, we're all doing the same thing, and this is actually pretty nice because throughout the last several years, it's been very rare that we get all four major market indices trading together in basically the same place. All four of these indices are very, very close to all-time highs, and all of them are consolidating and printing the same pattern, which typically when you have a market where all four indices are behaving together, that's usually a market that's going to rally or what's going to move in a strong direction one way or the other. Typically when you have market corrections, that's actually when you have the four indices correlated the best because they're all just moving down together. When you have a strong rally, you typically want all four indices moving up together. And when the four indices are kind of chopping around and doing their own thing, that's usually when you have a range-bound environment. That's when you'll have maybe one index leading and another index kind of like falling behind. And so typically if you want a strong rally, you want to see all the indices kind of moving together. And that's what we're seeing right now. All four of them are doing the same thing, and all four of them are trading the same patterns and are trading, relatively speaking, in the same areas. So that is, in my mind, another sign telling us that the market wants to rally. And it's just a matter of waiting for it to happen here. So what we're going to need now is for the Dow and IWM to pick up a little bit of steam and catch up to the SPY and the Qs, which are starting to break out. And we'll see that if the Dow can break above 300 or so. So that's the key level to watch on the Dow, is this 299 to 300. Now, just like the other two, again, you see I actually left the rectangle from last week on the Dow. You can see the range that we're in. You can see, relatively speaking, we've already kind of decided that we're ready to move past that range. So as long as we don't head back below the 20 and head back below 290, I think we're fine. Look at the space between the 20 period and the 50. Again, showing a trend that's starting to emerge. Often when you see the moving averages like this, you have to assume there's some momentum to this. Because they're basically showing you what price is doing, and it's based off of human behavior. And it's strange to describe it this way, but there's a certain amount of momentum to the way humans trade and the way that they visualize equities and assets. And so at the moment, there's this momentum that's starting to shift upwards, and that's likely going to persist. And if it does, we're going to see a rally coming forward. Now, of course, there's always going to be a shift in character, especially if news comes out. But at the moment, what I'm anticipating, again, is a move past that. And if we don't get that move, and if we come back, well, we know the key levels again. It's the same as the other two. We want to see price action hold above the 20, hold above the previous levels. Now, in this particular case, if we head back to the 50, that's troublesome because we've already kind of moved so far beyond that. And that would put us right back in the middle of the range that we've spent basically all summer in, and even part of fall. We don't really want to get back there. But again, as long as we hold above 280, it's not the end of the world. But it would definitely be more indicative of a market that wants to stay stuck in neutral and range bound rather than one that wants to rally. And that would mean we'd have to adjust our approach to trading. And then finally we have IWM. And as you can see, IWM has really, really picked up the strength. If you look at that rectangle from August to about November, IWM already broke out from it in October and in the beginning of November. And we're way beyond that. Right? So the small caps have picked up a lot of steam. And this is a good sign because, again, the small caps, as we go over every week, are the more volatile assets as far as these four major indexes are concerned. And not only are they're more volatile, they're more risky. And the fact that traders are willing to assume risk and are willing to hold these even when the market has some corrective candles is a sign of progress. And it's a sign that traders are beginning to get more emboldened and are willing to look for profits rather than being worried about taking losses. And so overall, this is a good sign that the market wants to rally as well. You can see we printed a triangle in November. We've already broken past that. And while we're starting to lose a little bit of momentum here, you can see this ascending trend line. We're starting to trade down below it. It's not that critical. that we lose this trend line, because really it's more, that trend line is really more indicative of this triangle that we broke through. And as you can see, what we're printing here is just a bull flag as we kind of consolidate sideways, probably waiting to catch up to the moving averages. You can see the spread of the moving averages, and you can see the train tracks starting to form, showing an equity that wants to probably continue rallying. And overall, again, this is another bullish chart and another chart showing us a market that is probably going to rally. Very similar to the others. What are the signs that this rally is dead, or that we're more range bound? Well, we're gonna have to fall back below this triangle, particularly the support level here around 178, and more importantly the 20-period moving average. And if we really fail at the 20, there's a long way to go to head to the 50, so there's a decent chance we don't make our way down there. Because of the strength in IWM, I'd expect them to not test the 50. There's a gap here that we never filled that maybe comes into play. But that would only happen if, again, we get a failure in price action here, which at the moment I'm not anticipating. So with IWM, unlike the others, there's chance for us to fail the 20 and still be okay. If IWM fails the 20 and heads back south, I think that's a change in character in the market, and again would likely tell us that the market is not really wanting to rally, and is probably going to be stuck range bound, in which case we're going to have to go ahead and readjust how we go ahead and trade and approach the rest of December. But for now, my expectation is that IWM will stay above 178 and will try to break out past that. And then we'll see what happens, whether that breakout holds or not. But my expectation from here to next Wednesday is that we hold above 178 or so, the 20-period moving average at worst, and we try to just build off of this candle and off of this triangle that was working through that, through all of that distribution that we or supply that we came across on that day on November 9th. And so when we look at it as a whole, we look at the four major market indices as an aggregate. You have a market where all the indices are at all-time highs, or very close to all-time highs. We have a market where all the indices are emerging from prior ranges and starting to peek their head above as they look to move upwards. We have four indices that have moving averages that are starting to turn upwards sharply and starting to spread out, indicating a strong trend. You put all that together, there's no negative here telling us that this market is going to reverse. Does that mean the market won't reverse? No, there's always a chance it does. But we have an understanding now of what the market's doing, and we know the reference points that'll tell us the market has reversed. And as long as it doesn't, then we can expect this rally to start to build up and start to move forward. And so at the moment, all indications are that the market wants to rally. And so my trading process is going to be similar. I'm just going to look at long trades, which is what we focused on all year anyway. But we're going to try to take advantage of some of this momentum that's starting to build, and make sure we could participate in some of these rallies. And more than anything, just at the moment, I'm just trying to make sure people aren't too timid about this, and aren't worried just because we've had 2 or 3 red candles in the market. You can see that overall, everything that we're pointing at is a market that looks like it wants to rally. And so that's how we want to go ahead and approach it with our trading. Okay? So that's the 4 major markets. If anyone has any questions, you can feel free to type it into the chat. If you have a chart you want me to look at, feel free to type that as well. But just generally speaking, if you guys want me to look at something, just type it in. Or if you have a question regarding what I was saying, feel free to type that in as well. All right, so let's take a quick look at the U.S. dollar. A U.S. dollar, as we mentioned last week, is starting to really struggle. And you can see this pretty clearly here. This index, of course, just shows what the U.S. dollar looks like as an aggregate, and it's falling apart. Right? It's breaking to new lows. It's accelerating, and overall, this is not a bullish picture for the U.S. dollar. Interestingly, it hasn't really reflected too much in gold and silver. We'll get to that in a bit. If you look at the euro-U.S. dollar cross, and again, in this particular chart, up is good for the euro, and bad for the dollar, right? So this, of course, is the same as a U.S. dollar drop. And as you can see, the euro is breaking out and really blasting off. And this is something we looked at last week, and the potential for this. And it has been a pretty strong move. Any of you guys that trade Forex, this was a pretty nice breakout to trade, and is really starting to give some nice returns. I think at this point, even if the dollar bounces, it's only to kind of reconfirm this breakout. And I think this is again indicative of a dollar that is really starting to struggle and getting weaker. If we look at the US dollar versus the Canadian, we could again see the dollar at lows and really struggling. Got a lot of potential news here, which is why it was covering up the bit of the chart here. But really the level of support was up here somewhere around 130, and we're dropping below that. So this is negative as well, again showing a dollar that's really starting to struggle. And then the last one we'll look at is the US versus the yen. And in this particular case, I think this again is indicative of the yen being pretty weak as well, rather than any kind of real sign of dollar strength. So this is the one cross where the dollar is actually still holding up a bit. It's not really doing that well either. You have this support level around 104.2 that it broke down from a few times, but it's been able to hold, and now it's going to come up and re-challenge this longer-term trend, which again is still bearish. And it's still, the moving averages are all in the wrong direction and doing the same thing. So this is the one positive sign for the dollar, but I think overall, if we look at it just as a whole, the US dollar is really struggling. Now, the odd thing for me, and Fat Boys, I think you were asking me about gold and silver this week. I don't know if you're in here or not, but you said you traded it long and you picked up hopefully a nice bounce off of this. But the odd thing for me is that the US dollar has been struggling quite a bit, and gold and silver haven't really benefited from it. Now, yes, over the last 2 days, the breakdown in the dollar has led to a move up in gold and silver, but generally speaking, this chart's not that impressive either. Okay, you're in here. So this is a better, I'll give you a little bit more description of what's going on here, at least as far as I could tell. Now, I can't tell you exactly, fundamentally speaking, what the reason is why gold and silver has struggled. Part of it comes down to Bitcoin, but I don't think that's the whole picture, and I don't really know what the whole picture is, but I do think gold and silver were due for a bounce, particularly as we head into the 200-day moving average, and particularly with the US dollar breaking down, right? And so we're seeing that over the last 2 days, a very strong bounce. What worries me about them is that there's still so much overhead resistance here. There's this band here of price action between about 174 on GLD and about 180. And that's a lot of resistance we're going to have to break through. And you can see the moving averages have really started to turn south and started to come down. That's going to go ahead and offer more resistance as we push up. So this is the one issue I have with gold and silver right now, is we're finally seeing a relief bounce. But is this kind of a dead cat bounce where we come up and hit resistance and then fall right back down? Maybe, maybe not. Maybe we could push through all that. What I do know is it's going to be a choppy trade as we try to get through that. And the only way we really break through that in one quick move is if we see a huge breakdown in the dollar and it continues to head south, which could happen. But this is my one concern with gold and silver, is I expected a bounce here, and it did bounce. But I want to see what happens as it comes into this big mess of price action. And if we look at SLV, we'll see a similar picture, where there's this mess of price action. Now you'll see SLV, it held up better than gold, and it held up better than GLD, right? Because it found support, and it didn't break below that. But it still has a lot of overhead resistance that it has to contend with. And out of the two, I would say this is the better bet as far as breaking through that first. And I think if we see SLV break past, say, 23, there's probably a good sign that GLD will follow suit and try to break through a lot of that overhead resistance. But we'll see. We'll see what ends up happening. But this is the one issue I have with the gold and silver trade right now, is I'm seeing a lot of weakness out of the US dollar, but I'm only seeing minor gains out of gold and silver. And again, if you contrast that to what we're seeing out of Bitcoin, and the blast off it's had, and again, I know it's a cryptocurrency, it's different from gold and silver, but it's also, to a certain extent, this is an alternate value play that benefits off of the erosion of the US dollar, right? And so in a lot of senses, this has usurped what gold does for certain investors. Not for all investors, but there's a certain percentage of investors now that consider this the inverse dollar play as opposed to gold and silver. and as you can see, it's done massively. Now, of course, not all of Bitcoin's value is tied to the opposite of the U.S. dollar, um, and so that's not everything that's going on. But there's a part of this trade, and the part that I understand is that there is money flowing away from gold and silver, which were more traditionally the safe haven assets when people were worried about the dollar or worried about the market. And while people aren't worried about the market at all right now, I could see some worry about the U.S. dollar and about the dollar, currencies in general. Um, but a lot of the younger generation would rather flock to Bitcoin over gold and silver, and so that's a piece of what's going on. But I don't think that's the whole picture. And to be honest, I don't know the whole picture because I'm not really a fundamentals guy. I'm more of a technical guy, and I really like the pattern. To me, the chart tells me what I need to know, and so what the chart's telling me right now is that there's been a shift in character with gold and silver. Now, long term, it's still fine. And I think that's the key here. Is if we look at the big picture, this is just a retracement, and so there's still every bit the possibility that this comes right back through and starts to make its way upwards. I don't have any problem with this in the long term, uh, but in the short to intermediate term, I'm just not sure what's going on here and why it's still struggling. But the 200-day, this is the first time it's tested it in a very long time. It found support, and now it's just a matter of breaking through all this um, and making its way upwards. And there's a pretty good chance it does so. It just might not be a clean trade. And so your next question, what about oil? That's perfect because that's what I was about to cover next, which is we look at crude oil here. We finally have been able to leave this death candle from back in March behind, or April. So we have a clean picture of oil again. And as you can see, oil is breaking out. It's doing something very similar to what the markets are doing, which is you have this range that it's been stuck in. And as you can see, oil has been in a very clear range since all the way back in May, with a low around 34 and a high right around 45, 44, somewhere around there. And we broke out. We're consolidating above it, establishing and reconfirming the support, or reconfirming the breakout as we come down and test. And what was resistance is now turning into support. This is looking like oil wants to break out, and this is again indicative of, and I think a big portion of this is the idea that we're going to kind of go back. We're going to start leaving our homes again, and with the vaccine, our economy is going to start to recover a bit more, which leads to more energy consumption, which leads to more oil demand. And I think that's what this is telling us. So, it's not necessarily a negative. Now, we don't want to see oil rally too sharply because I don't know that our economy is ready to really sustain really high oil prices. But, 45 is still not bad. And I would say overall this is a chart that's breaking out and wants to move higher. We looked at last week, we went to FinViz, right? And we looked at some of the sectors that are doing well. And energy has actually done pretty well over the last few months. If you look at 1 month performance, energy is up. If you look at 3 month performance, energy's up. So there's been, energy, and which of course a lot of that is oil names, has really started to pick up some steam. Now, in the last week it's been poor, and it's starting to pick up today again. And it's an area that you maybe want to pay attention to moving forward, because it's clear on this chart. This right here is telling us exactly what we're seeing right here with energy over the last month and over the last 3 months. And, particularly today, where we're starting to get the bounce off of yesterday or this week. You can see this week it's been kind of stuck in neutral, but it's starting to pick up again today. And that's exactly what we're seeing in that screener. And so this is not a bad place to look at oil names if you want to look at it. This is actually a very interesting week because we're getting a very broad mix of stocks and sectors that are doing well versus stocks and sectors that are not. And so this is one of the kinds of, every now and then we get a market where it comes down to picking the stocks, right? And not necessarily where everything moves together. And I feel like we're in one of those moments where there's different areas of the market that are doing well and not. So it's up to us to make sure we figure out which stocks we like, and make sure we pick ones that are ready to move, and if so, we should be able to benefit from it. But generally speaking, oil, like I said, is looking pretty good, and it looks like it wants to move upwards and start to rally. So I like it at the moment better than gold and silver, but gold and silver moving up again, and they should continue to move up a little bit more. I'm just worried about that overhead resistance. All right, so that covers oil, gold, silver. Anyone in here, if you have another chart you want me to look at, feel free to put it in there. Fat Boys, you want to look at, speaking of energy names, you want me to look at Sandridge. And we'll see a similar picture. I think, did we look at this recently? I think so, considering I had a candle on here. Looks like we looked at it 2 weeks ago. So what we have here is a continuation of the pattern we're seeing on oil. We had a range. We broke out. We flagged, which is what we were looking at that day. I think it was, we had the one green candle and then we had the red one. We were trying to figure out how it was going to consolidate. You can see what it ended up doing. You can see what's interesting here is the shift, right? So you take a look here. After we came up, and we came back into this triangle, you notice the wicks over the next, 1, 2, 3, 4, 5, 6 days, right? Where it was really struggling to break out. And so this is a good way for you to decide when you're ready to enter a stock, is you see all these wicks, and then you see we finally get a change, where now all of a sudden, instead of closing weak and selling off into the close, we have a decent close into strength. That's usually indicative of a stock that's ready to break out of its previous range. Now, in this particular case, it's not fully done yet. As you can see, as we came up to the top of the range, we had another strong selling wick, a hammer candle, which is not a good sign at the top. And then the sell-off actually on Monday, right, and yesterday. So if you look at this, we're not fully out yet, but I do think that we've seen a change in character where now we're not selling off back into the triangle. We're selling off and holding at the top of the triangle. So I think that this is a stock that's slowly pushing upwards, and we have kind of a trend here developing, where it's starting to kind of pull back. Once it breaks this, I think it should be able to break past 3 and start to make its way upwards. And like I said, you can see it pretty clearly where at first this is all a vacuum. It's just wicks, right? And then now the bodies of the candles are in this area. So what we need next is for the bodies of the candles to leave that area, right? And so that would be the next step. Now, there is, of course, a chance that it fails, but if it does fail, we have a very clear indicator now. We'll go back to our rectangle. If it's trading here, then it's a failed trade. If it's trading here on the other side of these trend lines, then it's going to be a successful trade, or it's going to be a trade on its way to succeeding. So I think it's pretty clear to judge what it's going to do just based off of this picture here. So that's the way I would approach it right now. Watch for it to break this downtrend and make its way back up. But I think generally speaking, it's mimicking what we're seeing on oil, which was a move upwards, and then it's consolidated this week, and it's starting to bounce today, which is almost identical to what we're seeing on the crude chart. Again, if you go back to crude and you take a look, and it's the same picture basically. Trading sideways, it kind of broke out, and then it's just kind of consolidated over the last 4 or 5 days, and it's starting to break out again today. And it's like I said, it's doing something very similar. It's just a matter of that breakout sustaining and making its way past 3. Now, if it does get past 3, let's take a look at the longer term chart and see what we're looking at here. You can see this is a stock that's been struggling for a while now, right? Again, we go just go back. The farther we go back, the uglier the chart gets, right? So that's something to keep in mind. Is this thing's not going to rally indefinitely because it's a stock that's been weak for a while. So we could look at maybe the 320 area as a potential target. I don't think it gets up to here, but this will be the next line, and this will be the area where I would definitely be probably done with this trade would be around the 420 area. Um, but it should make its way up to 320 to 350, and that would be a good area to start to look at maybe taking profits, assuming you're in this or you want to get in this. And the next level will be 420. Like I said, you don't normally when you have a trend like this. Well, I guess we already had it. So usually you don't go from straight down to straight up. We did have a base, and you did. Usually it goes from one direction to neutral. So we had a neutral for a while. Now we're starting to get bullish. Um, we'll see how long it persists. All right. So the other one you want to look at is U.S. Steel. So the last time we looked at U.S. Steel was when it was breaking this trend, um, and it's had a very nice move since then. Uh, I kind of regret this because obviously we looked at this chart and we didn't really go ahead and trade it. So here's this is actually a good picture of what I was talking about with these moving averages. Notice how the moving averages fanned out, and notice how that trend, that breakout, has turned into a pretty strong rally and a strong trend upwards. Um, that this pattern here is a pattern that has really given me a lot of profits throughout my trading career. Um, Now, I don't normally use moving averages as a means of entering or exiting trades, but every now and then, I think they give you good corroborating evidence of what a chart is telling you. So in this particular case, we had this triangle, we had this breakout, and then as it started to move past it, you could see the moving averages start to tell you that this is starting to get ready to rally, and that's what we've seen so far. Now, your question is, you want to get back in. I think you have to wait a while to get back in. The farther away this is from the 20, the farther the 20 is from the 50, when you have something this spaced out, it's usually not a good idea to try to get in, because it's going to revert back to the mean, and it's going to come back and fill in a lot of this area. So I think at this point you have to just put it on your watch list, and you have to wait. And if we look at the weekly chart, again, try to get a better idea of what the long-term picture is. You can see that we're actually heading into some pretty key areas here. Let's extend some of these trend lines. We had these key zones here as well. You can see all of these zones have really played an important factor, right? And so if we look at that, and again, this goes back to, you just go ahead and follow it, and you can see there were certain price inflection points that were kind of important, right? So as we look at it like this, you can see it's approaching a pretty decent resistance area. And so if you wanted to get back in this, I would say look at these levels. So 1350 or 1320 would be the first level you want to get at, but with the understanding that there's a pretty good chance it comes all the way back down to 10. 10 would be a very good level, and I would not expect it to lose 10. I wouldn't be looking at getting in at 7. I'd be looking to get somewhere around 10 or somewhere around 13 to 12, based off of when it comes back down. And I would not expect it to really break above 1680 to 17 on this move that it has right now. So again, it's very strong right now, but it's so extended that the risk reward is just not good for us at this point. So we have to be patient and wait for a better opportunity on it. This is one that had good opportunities a couple of weeks ago, and we weren't paying. I wasn't paying attention, so I didn't see this, but we missed out on some nice trades here. But at the moment, this is what I was talking about before. We don't want to be undisciplined. We see a stock like this that's moving. Rather than try to get into this and try to chase it, backtrack and try to figure out, well, what stocks are still doing this? You know? And try to find stocks that are still getting ready to pull off a move like what it's doing right now. And that's typically how I react to a stock like this. If I see something like this and I look at it, I'm like, wow, well, I missed this, but I never really think to myself, man, I need to get in now. Usually what I'll do is what we just did. I'll take a look at it and go, well, if it pulls back, where would I be happy with it and still assume that this trend is intact? But more importantly, what stocks are going to do something similar that maybe haven't done it yet? So what stocks have maybe broken a downtrend and are now starting to get above a current level, and they're starting to do this where they were trading below it, then they're trading above it, and consolidating, which again is a pattern reminiscent of what the markets are doing right now. Um, and if so, will we get the stock to do this, right? So that's what I like to do in this situation is I try to look for the similar pattern and look for it in other names. Okay? All right, well, I think that covers it for today. Thank you, Fat Boys, for participating. Those of you that were attending and were watching, thank you. And anyone that watches this on a replay, if you ever have a chart request, you can, like I said before, you can always ask me on Twitter at StockDarts. I'd be more than happy to filter out some charts that way. Other than that, hope you guys have a good rest of this week and weekend, and we'll meet again next Wednesday.